Hello, I'm David Cassidy with the weekly market summary for the week ending Friday the 16th of October. As you can see from the accompanying table, overall it had been a mixed week. While US equity markets rose slightly, UK and European equity markets ended the week lower. This differential was predominantly thanks to new localised coronavirus lockdowns after new daily infections nearly touched 140,000 last Thursday, the 15th of October. However, while these dark clouds remain hanging over us, it is worth remembering the resilience of the US economy and equity markets over the summer, when their daily new cases were consistently running at over 70,000. As such, we believe that the UK and Europe should also be strong enough to withstand the new lockdown measures. The FTSE 100 index was among the worst performing equity markets due to a lack of progress in Brexit talks, although the FTSE actually rose strongly last Friday, with the FTSE 100 up just a tad under 1.5% after Boris Johnson announced that talks between the UK and the EU over a post-Brexit trade agreement were over. However, and unsurprisingly, this is unlikely to be the end of the Brexit saga, as Ursula von der Leyen, the President of the European Commission, tweeted that an EU negotiation team will be in London this week to, quote, intensify negotiations. While speculation has now turned from a Canada-style relationship to a far less comprehensive one that is similar to the EU's with Australia, this is effectively a no-deal Brexit, as the bulk of their trade is done on World Trade Organization (WTO) rules. And if tariffs are imposed, it means that UK exporters could lose some of their competitiveness, while we, UK consumers, could face higher prices for European goods. However, it should be noted that the tariffs imposed by both the US and China over the past 2 years during their trade war did result in a small reduction in trade, but it didn't significantly impact prices and inflation, as many companies absorbed the costs of the tariffs by reducing the prices of their exports. There are also plenty of reasons to be positive on UK equities, having fallen by 21.52% since the start of the year. UK equities have attractive valuations, low price to earnings multiples, and an attractive dividend yield. Furthermore, after a spate of coronavirus-induced dividend cuts and cancellations, many companies are starting to restart or increase their payments. In the US, there was something for everyone, depending on whether you view the glass as half full or half empty. The chances of a new fiscal stimulus deal were being agreed before the presidential election on the 3rd of November this year are now nigh on impossible, and they are slim, to say the least, before the presidential inauguration on the 20th of January 2021. However, US consumers clearly aren't running out of money, as US retail sales smashed expectations by growing 1.9% in September. Additionally, while US initial jobless claims rose, which is negative, to 898,000 from 840,000 the previous week, US continuing jobless claims were substantially lower, which is positive, at just over 10 million versus 11 million the week before. This week, in the US, we have housing data, the Fed's Beige Book, weekly jobless claims, and PMI data. And here in the UK, we have CPI inflation, retail sales, and PMI data. In Europe, we have consumer confidence and PMI. And from China, we have Q3 gross domestic product, sales production, and retail sales.